Hi folks, welcome back to our final video, which is, well, I shouldn't say final, I think I might do one more after this, but final step in the accounting process. This video is going to focus on step 3, where we summarize all of the journal entries that we made into the general journal. So let's talk a little bit more about that process. But before we do, just a quick review of what we just did in the previous step, step 2. We took all the transactions we analyzed and we put them into the general journal. The journal are the books into which all of these debits and credits go. All right, so now the question becomes, if I was to look at all of these accounts, I see cash going up here, now cash is going down, now cash is going down here, cash going down again and again. I'm looking at this and I'm saying, you know what? Can somebody tell me what the ending balance is in my cash account? I'd really like to know that. So what we do is we have a step 3, and step 3 is called summarizing the transactions. So by summarizing them, we mean, let's see what the impact was on each account. So let's take all the transactions that affect cash and put them in that particular ledger, a ledger being an account, okay, that keeps track of all of the increases and decreases or debits and credits in cash. And let's do the same thing for all of our other assets and all of our other liabilities and shareholders' equity accounts so we can track them. So what we're going to do now is we're going to take all these transactions that we did here where we had debits and credits, and we're going to go through step 3, which is a process that summarizes or posts to each individual account to capture the effect of all the debits and credits. So let's have a look at that process. This is step 3. So what happens here? Well, again, what we're doing is we're summarizing transactions. And summarizing means to post the journal entries to a ledger. Well, we're not going to use a fancy schmancy ledger. We're just going to use T accounts. Why? Because it gives us left and right. And that helps you to remember debits on the left, credits on the right. Okay? Notice what we've done is we've created a T account for each account that we've debited and credited. Notice that even though we've debited and credited cash more than once, we only have one account because we want to summarize all the debits to cash and all the credits to cash in one account. So we use the T accounts to help us do that. And notice it's going to give us the ending balance, and we can use that in the balance sheet, right? So let's go back and have a look at everything that we did on those transactions. So you remember here, this first transaction, cash went up. It went up on the left, and left meant debit, and contributed capital went up on the right, and right meant credit. So all we want to do now is we want to say, well, our beginning balance, BEGBAL means beginning balance, was 0. So was it for contributed capital. It was 0. But we debited cash when we got it in transaction A for $10,000, and we credited contributed capital, which was transaction A, for $10,000. So all we're doing is tracking it now through the T accounts to make sure we don't lose track of any journal entry and its effect on the accounts, because we want to be able to summarize these accounts to come up with a balance. So notice the setup here. Assets are all together on the left, and liabilities and shareholders' equity. We have a column for liabilities and a column for shareholders' equity. So the accountant tries to think in a very organized fashion. All assets on the left and liabilities and shareholders' equity on the right. So beginning balances are 0 because we didn't have any to open up December 1st, 2015, because that was Shelley Webster's first day of business, right? She didn't have any amounts. But now we do. We see that cash went up, and it went up on the left, and left was debit. So we're going to put the debit to cash in the cash T account and the credit to contributed capital here. We label them so we don't lose track of everything we've done. So you can go back here if you wanted to and say, okay, this guy's done. I could also put done here, right? I've done it. I don't have to do that. Some people might put a check mark. But if I see there's an A here, and I can go back and say, oh, I got an A there, that means I posted the entry that I journalized in step 2. What happened in B? Well, entry B said what happened? We got cash from the bank. So don't forget, we debited cash and credited the note payable. So what does that look like in our T account? It was transaction B. We debited cash, we looked to our notes payable, and we credited it in part B for $15,000. Right? Now let's go to transaction C. C, we bought equipment for cash, $5,000. So let's see how the T accounts can be summarized here. Well, again, we now have an asset equipment. Notice the equipment in transaction C, it went up on the left, and left meant debit. Don't forget, we debited the equipment for $5,000 and we credited cash. So we've got the credit up here to cash at $5,000 and it's C. So see, we're trying to make sure that all of the credits and all of the debits are in balance. So if we ever found out that our balance sheet didn't balance, we could always come back here and say, does every A have an A? Does every A debit have an A credit? Does every B debit have a B credit? You know what I mean? And does every, C debit, does it have a credit? In the C area. So that way you can make sure that you posted both sides of the debit and credit transaction to the T accounts to summarize and get the balance. Right? Now in D, what happened? We paid off some of the accounts payable. So what happened? We bought some, we bought some supplies on account. So what happened? Well, don't forget the supplies account went up. It didn't have an opening balance, but we just gave it a balance, right? We debited supplies. It's right here. Debit supplies, credit accounts payable. So now we've got to put the debit to supplies, $300, and the credit to accounts payable, $300, right? That's D. All right? So now that journal entry's been posted. Now what can we do? Let's go to E. Well, that was no transaction, so I don't have to worry. Let's go to F. What happened? That account payable that we had up here, don't forget, we paid it down. So we debited AP and credited cash. So how do we post that? We debited accounts payable in transaction F, and we credited cash. So every debit has a credit, right? Even in the posting process. Let's look at G. G said we bought supplies for cash. That's going to affect two asset accounts, right? We bought supplies in G for cash. We debited the supplies and we credited cash. So the debit has a credit, right? In the summarization of things. Now we see our last transaction that we're going to post, because don't forget in I there was no transaction. All Shelley did was order a server, so I is no debit or credit. But in H, she bought equipment, she paid cash $200, and she put the rest on account. So we have a debit to equipment, credit to cash, and credits to account payable from step 2. So how does that go into posting? Well, we debited our equipment, $1,000. We credited cash, and note again, H is matched up with H here, but we've got a credit of $200 and a debit of $1,000. The debits and credits don't balance in the posting until we adjust our accounts payable for $800. So notice that we've got an $800 credit to accounts payable and a credit to cash. The credits total $1,000 and the debits total $1,000. So we know once we post, we still have things in balance. Assets equals liabilities plus shareholders' equity. So what do you do here? Well, you're going to add up all the debits and all the credits. Here you can see we have debits of $25,000. If you added all of this up, what would you see? You would see you'd have credits, not $25,000, but all these credits would add up to what? $6,100, right? So these guys add up to $6,100, but that's $25,000. So you've got a net debit balance. When you take away the $6,100 from the $25,000, you've got a net debit balance of $18,000. We want to put the ending balance on the bottom. So notice we've got ending balance, $18,900. Notice here we have an ending balance, which is a net credit of $800. Why? Because we had $11,000 in credits, but we only had a debit of $300. So we've got a net credit balance here of $800. So now that you kind of understand the process, you can complete it for all the asset accounts. We see that we debited supplies twice, so the ending balance is 900. We didn't have any credits. And we debited the equipment twice, so its ending balance is 6,000, and again it's on the debit side. With the liabilities, we've already gone through accounts payable. We only had one entry to notes payable, so its ending balance is 15,000. And on the shareholders' equity side, we only had one transaction affecting contributed capital. We didn't have anything affecting retained earnings, so it started at 0 and it ends right now at 0. So what we can do now is we're going to take these ending balances and we're going to be able to use them to prepare a balance sheet. But before we do that, we're going to show you something else in the next video, which shows you there's a report you can do called a trial balance, which summarizes all these ending balances. So we'll get to that in a few minutes. I hope you found this summarization process video helpful.